think what governs a lot of our investment decisions, other than being longer term and trying to buy businesses that we think can compound for reasonable periods of time, and companies that have a good moat around them, and all the things that your wish list if you're going to be a long term investor. We are concerned about the debt. And so, this proverbial debt issue, which is not gone, hasn't gone away and continues to get worse, which is quite interesting. And we've talked about this before in a previous show. I mean, there's just so much global debt out there. So what does that mean for us? It means we want to buy businesses that are really essential, very critical to the global economy. If there is a debt problem, or, we get into a lot of volatility, they should be able to at least weather it on a relative basis a lot better than other companies. Harder assets. And so that keeps us away from, I'll tell you where it keeps us away from, and then I'll say where we gravitate towards. It keeps us away from a lot of leveraged financials.
Hi, and welcome to Wealthion. I'm James Conner. Well, the first half of the year in the financial markets was nothing short of exceptional, with the S&P up 15% on the year. But as we enter the second half of the year, there's a lot of potential landmines. The economy is slowing, but does the economy go negative? Does inflation keep growing? Is stagflation a possibility? Does the Fed cut rates this year? To help answer these questions, my guest today is Jonathan Wellum of Rocklinc Investment Partners. And Rocklinc is a Wealthion endorsed financial advisor for Canadian investors. Jonathan, thank you for joining us today. How are things in Toronto?
Very well, James. Good to speak with you also. Yeah, we're just chugging along here and interested in the final results tonight there in the Stanley Cup.
Jonathan, I want to begin our discussion with an overview of your firm, Rocklinc. And why don't we just start with a little history of the firm, and also maybe you can tell us about your investment style.
Sure. I got involved in the investment business back in 1990 in the mutual fund industry, and was fortunate to be in the industry at a fantastic time. And I started working with Michael Leachin. So we built AIC funds, which was quite well known in the Canadian marketplace. Now, we sold that business in 2009 to Manulife. And so in 2010, I thought, let's just set up something that I can control 100%. I can look after some of my own money and friends and relatives, and just sort of build a business around. So set up Rocklinc 2010. So we're in our 15th year. And private wealth management, we're registered as portfolio managers, investment fund dealer, and we also have the exempt market dealer. So we're all licensed discretionary money managers. And we just wanted to, again, apply a disciplined value approach to investing. So, people come in, we have about 300 plus families now come in, and we just, customize portfolios for them, buy individual stocks, bonds, securities, and so forth that are going to meet their objectives. But it's a very disciplined, what we would consider a longer term approach, trying to find businesses that we think are a reasonable value and can compound for extended periods of time. So you get that power of deferred taxation and the compounding. We do have two funds. We have a pool that we use just for efficiency and effectiveness. So we have a Rocklinc Partners fund that we started in 2017, and that's we use that more and more actually in people's accounts because it's very, very efficient. And we have one offshore fund that, again, it mirrors what we're doing in our overall assets with our clients, and that's based in the Cayman Islands, and that's for investors who just want to have some money outside of the country. So basically, disciplined, focused investing. 20-25 stocks. We like to do our work on the businesses and then take reasonable positions so we can do well over time. We don't care about market indexes and things like that. We're way off index. We're not trying to mirror the index or copy it. We're just trying to be as different as possible, but finding a handful of great companies that we believe are going to do well over 3 to 5 year period, and hopefully even longer.
And you mentioned that you have 20 to 25 companies within your portfolios. Is there a minimum market cap? And also, what would be the breakdown between Canadian versus US names?
Yeah, good questions. We don't have a stated minimum, but the market cap generally is going to be north of $5 billion, $10 billion in most cases. Now, we do have a couple of companies that are smaller, that are a couple hundred million, and we just believe that these companies are unique. We've come across them because our assets aren't that massive. We can take reasonable positions in these companies. So a company like Gold Royalty, GROY is the stock code. That's a unique company in our view. It's well positioned in the precious metals. It's small, but it's got great management, some great assets, and we think it's way undervalued. So we'll build a position in a company like that. But generally speaking, we're looking for companies that have pretty long established track records, and therefore they're going to be typically more than $10 billion in market size. In terms of geographic exposure, we will invest anywhere in the world, but let me just pull that. I can say make that statement, then pull it back quickly and say, okay, we want to be in markets where we can read good annual reports, understand the companies, phone the companies, talk to the management of the company, and are in markets that we understand. So that really keeps us to Europe. Um, we could go into Japan, but we're going to buy a global company like a Toyota or something like that, which we could own. But most of the money would be North American based, but with global exposure. And the mix typically at this point would be probably about 40%, 35-40% Canadian based companies, and the remainder would be outside of Canada with a preponderance in the US. But I think in our portfolios, we only have maybe two companies that are 100% Canadian, and those again would be like a REIT. We own some smart centers or something like that, and people want to get a high dividend. That's a Canadian company, and but largely our Canadian-based companies are fairly global and have they've got assets in several continents. These are companies that are doing very well, building great businesses around the world.
And what would be the breakdown between equity versus fixed income? And also, what's your cash position right now?
Yes, yeah, good questions. And because we customize the portfolios, I'll give you our overall asset allocation, but then again, I'll just explain a little bit more. So right now we'd be about 65% equities, 35% short-term interest securities. We have not played, the long-term market on bonds and things like that. We just don't see the returns being justified. So in terms of interest-bearing securities, we've kept it quite short, high quality. We're not adding value as equity guys by playing the yield curve. And there's people that can do that, and we respect that. But from our perspective, we can clip 5%, and it's pretty well guaranteed short term. That we'll use that to buffer the equity volatility, and also just to build some cash flow for clients that want that. So 65-35 at this point in time. But we've got some clients where they're 90%, 95% invested, and these are younger clients. They're aggressively investing every month, and they want to have larger exposure. And then we've got individuals who are literally widows who are very close to the wire, and so we're going to keep them maybe 40 or 50% equity exposure. They're very nervous about market volatility and so forth. So because we've got such a range of clients, I think the point there would be customization will govern a lot of our asset allocation. I would just say this, that if someone comes in and we have full discretion and they have a long-term view, I would basically be looking at about 70%, I think, equities, and holding back about 30% given market valuations, and the fact that I want to have some powder dry so that if the market gets a little crazy, then we can step in and buy some of our favorite companies at better prices. So I think that's probably where we sit right now. We have a number of companies that we like, but the market is not cheap. There's a lot of obstacles out there that could derail the marketplace. And we like Warren Buffett, and I think Buffett's pretty sharp. Keep a little cash, and if you can grab 5% while you're sitting there and waiting for it, we're quite happy to clip the coupon right now, and then pick off businesses that we think are cheap or could become cheap if there's a problem, or something happens in the world that jolts the market.
And you already threw out a few names, but maybe you can give us some more detail on what sectors you like right now, and maybe mention some more of your favorite names and where you see value.
Yeah. So overall, I think what governs a lot of our investment decisions, other than being longer term and trying to buy businesses that we think can compound for reasonable periods of time, and companies that have a good moat around them, and all the things that your wish list if you're going to be a long term investor, we are concerned about the debt. And so, this proverbial debt issue, which is not gone, hasn't gone away and continues to get worse, which is quite interesting. And we've talked about this before in a previous show. I mean, there's just so much global debt out there. So what does that mean for us? It means we want to buy businesses that are really essential, very critical to the global economy. If there is a debt problem, or we get into a lot of volatility, they should be able to at least weather it on a relative basis a lot better than other companies. Harder assets, and so that keeps us away from. I'll tell you where it keeps us away from, and then I'll say where we gravitate towards. It keeps us away from a lot of leveraged financials. So we have, as Canadians, I mean, Canadians, when they build a portfolio, they usually have half of it in banks. You can't go wrong by owning a bank. While our view is, well, we're not all that thrilled about the banks. We probably have about 2% of our client assets actually in banks, and maybe 1.5% in Canadian banks. That doesn't mean they're going to blow up tomorrow, but it just means that they've got a lot of debt. They're leveraged into a Canadian market that is very leveraged right through the whole system, from the government to personal leverage in Canada is one of the worst in the world. And so mortgages and all those things. We look at that and say, you know what, we'll stay clear of that. We don't need to be in that space. We'd rather have fee-based financials, which are much more predictable. So asset managers, or private equity companies, or even the royalty companies and the precious metals companies, which really are investment bankers to miners. So we'd much rather be in that space. The other area that we would go into then is we're going to look for companies that are harder assets, so infrastructure assets, companies with long-term contracts in areas that control long-term cash flow streams, inflation adjusted. So, we own some of the Brookfield assets. We think that they're well positioned, they're well run, they're not in highly regulated utilities, which we'd be more concerned about. And we own some of the precious metals, which is certainly a space that exceptionally well. And we like that space because we think, the debt crisis, the continual erosion of our currencies, they can't stop it. I mean, it's impossible. One way or another, we're in this sort of catch-22 situation where we've got way too much debt, and either we're going to have inflation, and that'll chip away, or if we have, if the rates don't come down, we're going to have financial problems. If the rates do come down, then they'll continue to stimulate. Either way, we think you're going to lose purchasing power, and so we want to be in some of the precious metals. In that space, we do own mostly royalty companies, so we do have some Franco-Nevada, Royal Gold. We have some Wheaton Precious Metals, Sandstorm, Osisko, Gold Royalty I already mentioned. We do own some Agnico Eagle. We think that they're one of the best miners. And, for us, buying some of the juniors, that's not what our clients are in for. We respect people that do that, but we have to know our circle of competence, and that's not looking down holes in the ground and trying to find the next great mine. And we own a couple other small mines. We have, I guess, a little bit of Equinox for people who want a little bit more juice. We have some clients that'll come in and say, I do want to own a few smaller miners. And again, that's run by Ross Beatty, an exceptionally, good manager. So we'll go after the companies that are in that space, that are run by great managers, have tremendous track records, and disciplined in what they're doing. So we have also some Silvercrest and for people. So that gives it a pretty good smattering, that space. We do love software companies also. So you get into technology, when you think of the software business itself, it's a great business. If you can develop a software that people purchase and integrate it into their company, you got them for life unless you really screw up, and they'll just keep buying that software, and they'll keep renewing their contract. You got pricing power. You don't have a lot of fixed costs, a lot of capex. So we own companies in that space, like a Roper, which is a well-run software business, is sort of a conglomerate of software enterprises. We've had some Microsoft. We still have some Microsoft on our books. We've done well in that. We're a little more hesitant in adding at these values, and some of the AI hype, I think, is just a little bit too much hype for us right now. So we're just being careful in that space. And then we have some industrial businesses that we think are essential to the continual transition, the green transition. So companies like Linde, which helps businesses be more effective in their energy consumption, and industrial gases and things like that. Boring, but just continue to chug along. Schneider Electric, we bought recently. Schneider, along with Eaton and Hubbell, are major players in the rebuild of the utilities, which have to be rebuilt. And they also are building data centers. And so that's going to be something that, again, with the with AI and EVs and all of these sorts of things, again, what we're trying to do is find longer term trends and then find great companies that are perched on some of these trends, and they don't have to knock the lights out, but as long as they just continue to chug along 5, 6, 7, 8% organic growth, they're going to make some good money. They're good free cash flow generators. Companies like Autodesk, Adobe, we've also got some exposure to. Again, great long-term businesses that have tremendous entrenchment in companies. It's hard to get rid of these guys, and they so they become real cash flow machines. So those are sort of, I give you a smattering of businesses. I mean, I think at the end of the day, we're looking for companies that are really great balance sheets, or no, either no debt or a debt that's very manageable and very controlled, and companies that are essential, and they have scarcity in the sense that they're usually in oligopolies. They're not going to disappear tomorrow, and they're perched in good industries. Yeah.
So I'm curious about the comments you made about the Canadian banks and why you have such a low weighting in them. And I guess you're really concerned about the leverage that they currently have. And I want to dive deeper into that. And when you look at the Canadian banks, it's a huge range in terms of performance this year. Royal Bank is up 5% on the year, but TD Bank is down, I believe, 12 to 15% on the year. But maybe
Yeah.
you can give us some more detail on why you're so concerned and what's happening within their loan portfolios. And do you see the risk coming from the residential side or commercial or both?
Yeah, I think it both, and it's interesting to see the divergence. No question, Royal Bank has been much more disciplined, and they didn't when back about a year ago, 2 years ago, I guess, we started looking at the average amortization period of mortgages, and it started to really start stretching out. And I'm sure, talked to people who have talked about this already. And so what the banks were doing is basically negotiating with clients and allowing them to extend the amortization period in order to deal with the increasing interest rates. And we look at that and we go, that's not a good thing. When you've got 18, 20% of the mortgage is amortizing at 35 years now, that's more renting than it is ownership. And so you start to get a little worried about that. So from our perspective, given the housing bubble, or certainly very high prices of housing, and then the fact that we've had so many people topping up and buying homes at high valuations and at low interest rates, and then you've got this revaluation of interest rates, that makes the personal or the retail side of the business very vulnerable. And we think that, again, even if it doesn't blow up, and I'm not, we're not looking at this as Armageddon. I mean, Armageddon could hit, at any time for a whole bunch of other reasons, but it's just going to be more and more loan losses and write downs, and there's not going to be the growth is going to be really hard to come by, and so there's going to be under pressure. And when you're leveraged, 12 to 1, that just puts pressure on the commercial side. Also, we talk to we have a commercial, we rent here in Burlington. We talk to a number of the large real estate agents in this area, and boy, it is abysmal when it comes to top tier office space. Running around here in Burlington, all through the area, like a lot of these buildings are like half full. People are working from home. The larger companies have changed work patterns for their employees, and there's a lot of stress. So the industrial is pretty solid. Tier 2 offices, so, but there's just pockets where there's problems, and the banks are they're making it very difficult for renegotiations. They're walking from mortgages. I was just talking to a real estate agent a couple of days ago, and she says it's amazing. People will line up a mortgage with the bank, and the next thing you know, before they even close, they'll back out. They're really watching their loan book very carefully. So that's good in one sense. I mean, banks are trying to protect themselves. But I think in terms of looking for asset appreciation and growth, we just look at it as dead money. It's just going to be very difficult. Now, that's a general statement. We've seen that there are differences. Royal Bank did not get into the extending and larger amortization periods as much as Bank of Montreal, and I think CIBC, TD did a little bit more of that. So the banks have a little bit different allocations there. The other thing is that TD, of course, got caught in the money laundering situation in the United States, which is probably what's taken them down a little bit more. And that's so you always got something that can an exogenous sort of factor that can hit one bank over another one. But I think just overall, retail situation is just going to be under pressure, and then the commercial doesn't help it at all. And so that softness, I think, will makes them unattractive at best. In fact, in Canada, some of the best, best performing up until the fact that up until they announced the Canadian Western Bank purchase. I mean, National Bank was doing very well and continues to plot along. And it's interesting because they're sort of more of a basic fee-based kind of business. They're not involved in a lot of the heavy, extensive lending and international operations like the other banks. So I'm not saying they're going to blow up. I'm just looking at them as leverage. As you know, whenever you're leveraged a lot, and if things don't work out well, mortgages certainly are underwater. It's a lot more Canadians underwater. Housing prices have easily dropped 20% all around the area where I am, and I'm looking at people who bought 2-3 years ago are down in some cases 25% from the peak if they bought right at the wrong time. That's going to have to run through the system. And part of it also, James, is looking at 15 years of almost negative in zero to negative interest rates. And we're going to pay up for that. And so we just don't want to be in businesses that could be more vulnerable to that payment problem. Going back to more of an equilibrium in the marketplace.
Yes, this whole work from home thing is having a significant impact on so many aspects of the economy. And I spoke to somebody recently who works for Oxford, and they own many of the large Class A buildings in
Yeah.
downtown Toronto. And they said on a typical Monday, only 5 to 10% of people are coming into the office.
I was in Ottawa. I don't do Ottawa too much, usually a couple times a year, but for 2 weeks in a row there, I was in Ottawa and for meetings, and you talk to all the people in Ottawa. I mean, the fight's going on there. They can't even get the federal employees back in 3 days a week. No one wants to go back. The traffic flow is just so much different when you're in Ottawa now. It used to be just all the roads were all backed up in the morning and so forth. And no, it makes a big difference. So what does that mean? I mean, we've seen the extremes in the extreme situations, like in the U.S., and why we'd be, just concerned about some of the regional banks down there who have more exposure to some of the commercial property. I mean, you've got properties that were going for high valuations just 6, 7, 8 years ago. Then they end up in Los Angeles or Chicago or even New York in these Democratic-run states and also cities. And the next thing you know, you've got a homeless problem right next to your building, and no one wants the building. And so there's one building, the name escapes me right now, just reading in LA that was going for quite the price, and basically no one wants it. I mean, no one literally wants this building. It's in the wrong place at the wrong time, and there isn't the demand to fill it. And what's that worth? Zero. In fact, it's probably worth negative value. So that's the sort of thing we want to just be careful. I mean, I think that's just going to have to go through the system at some point. There'll be various companies that have exposure. It's going to vary, and I know right now the banks are just watching their loan books really, really, really carefully.
Yeah, I had a conversation with somebody recently who's investing in numerous condos in downtown Toronto. And I think she said she has a portfolio of 6 condos, and she's losing money on 6 of them because her rent is $3,000 a month, but her expenses are over $4,000 a month.
Mhm.
And then of course there's the big reset associated with the valuation of the condo, right? So maybe it was worth $1 million 3 years ago, and now it's down to 750. So that's another big problem that's coming. And as you know, there's dozens and dozens of condos being built in downtown Toronto or in the greater Toronto area. And that's going to be another major issue in 2 or 3 years from now when people take over these condos, right? When they first bought them, they were worth $1 million, let's just say, and now they're going to be worth 750. So they're taking a big hit.
Well, and in many of these cities, they're not governed well. So the cities aren't governed well. Who wants to live downtown? I mean, there's a big shift going on, and so that's another factor, that the safety and the cleanliness, and do you want to be living in these downtown facilities? So if you just start to move that market just a certain percentage out, it really moves the value of these properties in a significant way. And so, yeah, we're again, those are all the reasons why we're just looking at it and saying, you know what, it's easier to go somewhere else. You can spend hours and hours and days and running all your spreadsheets and Excel spreadsheets and so forth. And I'm not sure it really gets to you. It adds a lot more value. And so we just say, hey, let's go somewhere else. I mean, it's like Warren Buffett, I think, when Charlie Munger used to say, they have that pile, that inbox on their desk, too hard. And so we look at some of these banks and we go, are they really going to make much money in the next few years? Are they going to go sideways at best, or maybe have some challenges? Let's go somewhere else where we don't have to think about it. and we're quite happy to do that in terms of where we're investing anyway. That's a benefit of being way off the index and just looking for a handful of companies that you like. We don't have to be in one sector. We can just stay clear of it if we want.
And when you look at the Canadian banks, it's really a reflection of what's happening in the economy, right? You're dealing with businesses and you're also dealing with the consumer. And the Bank of Canada recently cut rates. And of course, they did so before the US did, and that's very unusual. But do you think the Bank of Canada is foreseeing a problem coming a year or 2 years down
Yes.
the road? Is this why they got so aggressive?
Yeah, I think we saw the EU also cut, and we saw the Bank of Canada cut, and the U.S. has not cut yet. As you say, that's unusual, and of course, the concern would be weakness in our dollar. That the gap between U.S. rates and Canadian rates is actually quite large as you get out to the 10 year. It's fairly substantial. So you're saying, well, why do I want to own Canadian dollars? And so, I mean, the Bank of Canada is very concerned about about dropping rates before the U.S., but I think it does give us an indication. Yeah, we're in a soft economy. Now, the Canadian situation is, as you know, I mean, we've had, I mean, not that the politics in the U.S. is much better, but we've had very, very poor decision making at the federal level that has really devastated the Canadian economy, and we could be so much better off if we had much wiser decisions. So we've got regulations running out of control. We've got taxation going up. We've got them stymieing projects, capital projects in the resource sector. We've got a government that is passing laws and making it difficult to do business and to maneuver and so forth. So all of those things at the same time are really hitting our economy. We've got immigration levels that are just completely ridiculous because you just can't integrate that many people within the existing infrastructure, and so that's stressing all of that infrastructure, schools, hospitals, our roads, our buildings, our real estate, and so forth. So yeah, so I think the Bank of Canada is very concerned about that. The Canadian government also has piled up a tremendous amount of debt, so financing that's going to be very difficult. So yeah, so we're in a much softer situation, and really we require interest rates to actually be lower. But the risk there is that we can't be that much divergent from the U.S. or we'll definitely be in the 60s. 60-cent dollar. We could see a 65-cent dollar pretty quickly if we were to drop rates again. So that's, I think, the concern. But it does tell us that the Bank of Canada is very concerned about growth in Canada. I think it also means that probably the Fed will at least cut once, if not twice this year. And again, we take longer term investments. We don't spend a lot of time trying to guess what the Fed's going to do. But I think that they're obviously concerned with what's going on in the U.S. also, and if they do cut and continue spending the money, that's why we want to be in some of these assets that are going to protect us from purchasing power, because I think we could continue to see inflation, and we want to protect purchasing power.
So let's talk about the U.S. economy now, because really one of the only things that's really saving the Canadian economy is still the strength of the U.S. economy. But it appears to be slowing also. Q1 GDP was recently revised to 1.3%, down from 1.6%. And then there's a number of companies that are coming out and saying the consumer isn't spending money like they used to. Starbucks, for example, came out with week quarterly numbers saying the consumer in both the US and China were spending a lot less. They're not getting as much traffic into their stores. McDonald's also came out with and said the same thing. And I'm sure you heard about McDonald's implementing the new $5 a meal program. They're trying to get people back into their stores. And then when you look at the price of oil,
Mm-hmm.
in spite of what's happening in the Middle East, it's hanging in between $70 to $80 a barrel. Maybe that's a reflection of a weakening economy. I read recently about lumber being down 30% in the last 3 months. What's your sense of the U.S. economy here? Do you think there's reason for concern?
Yeah, I mean, it's under a lot of pressure. I mean, I think that when we look at the U.S. economy, again, we're looking at the businesses and how they're reporting. And as you've pointed out, you've given us a number of companies, and we've seen the same thing where it's discretionary spending. It is down. It's under a lot of pressure, and in certain states, it's even worse. So if you actually look at the states that are higher taxation levels, higher regulations, so those areas are even doing worse. And so, no, I think the U.S. is definitely slowing, and that would be expected. You've gone from almost zero interest rates up to 5%, and so that's being priced in. The thing that's really helped the U.S. is just these massive, deficits, and they're spending a lot of money, a lot of stimulation. Immigrants, these people flooding across the borders, money being spent at the municipal level, state level to support those initiatives and so forth. And then you've got a couple of wars, which obviously stimulate more deficit spending. If it wasn't for that, I think no, the U.S. would be much worse off, and the numbers would be worse, and it'd be in a recession. And also, I think from our perspective, we look to individuals like we have a lot of respect for David Rosenberg, who looks under the hood on these things, and you start looking at the employment numbers, and you realize they're not really as healthy as they're saying, and even the CPI numbers, we don't really take those as the ultimate judge of inflation. Inflation is definitely running higher than that, and so forth. So we put all of that together. And we go, you know what? It's tougher. The companies are having a tougher time growing their earnings, unless you're in certain areas that are favored. The stock market is being driven by fewer and fewer companies. Small cap companies have not done well this year. They're under a lot of pressure, and so it's a very split market. And I think that's the Fed is seeing some of that, and that will give them some incentives to see if they can't sort of knock rates down a little bit. In the debt, again, we talked about this. Other people talk about it. It's just not sustainable, and what's not sustainable will not be sustained. The fact that they've continued to be able to pull this forward and get away with this does not mean that they can continue to get away with it in the future. And so, with a 35, almost going to $36 trillion deficit, at 3-4%, that's over $1 trillion a year in interest now. And so these things are just really putting a lot of pressure on the U.S. economy also. And I think a lot will depend on the election also in the fall. I mean, clearly you've got quite the different worldview going on between Biden and Trump. And Trump clearly is much more growth oriented, cutting regulations, cutting taxation. But if God forbid the Democrats were elected again in that country, I mean, they've got taxation going up automatically. The Trump cuts from previously, they all of a sudden will kick in, and Biden seems convinced that taxation should go up, and that would be, I think, devastating to the growth prospects of the U.S. So we're just watching that, and that's why we're being very careful. That's why we're in companies that we think can weather, more pressure and very poor decision making on the part of the politicians, and also have global franchises so they can make money in not just one country or two countries, but make money around the world, and are sort of perched on long-term trends. So I think the U.S. is going to be increasing under more and more pressure economically, and we've seen that already.
And there's an ongoing debate on whether or not the U.S. is already in recession or going into a recession. What are your thoughts on that?
I think they're going into a recession. We don't get too caught up in sort of the specifics. It's soft. There's not a lot of growth. It's almost like there's a stagflation. Yeah, even if there's 1 or 2%, that's very, very anemic. It's weak. And when you consider the inflation rate is actually higher, I think, than what they're actually reporting, that tells you the growth's probably even worse. Because of course you're looking at real growth, and that you're adjusting real growth by what you think the inflation is. So if inflation is running higher, then I think the growth is even lower. The same thing in Canada. I mean, I think over the last number of years in Canada, we come back to our own context. If the inflation is 2-3% higher than what they're reporting, I mean, real inflation, food, like you're talking about actually going out and buying food and clothes and home costs, insurance costs, all of that, and you're not adjusting with all their hedonics and all of their fancy econometric models and so forth. That tells you the growth has been a lot less, and I think that's why we're experiencing, the collapse in standards of living in our country, and the same thing's happening in many of the states and in the U.S. also. I mean, the young people, they'll tell you what their standard of living is like. You try to come out and try to buy a home, income levels have not kept up. People are a lot poorer now than they were 5, 10, 20 years ago. It's a substantial difference. And the massive expansion of the state has just crowded out so much wealth, and taken the capital and taken the prosperity within the economy and just shaken it, because the government now controls too much of the economy, and the growth level, when you have almost 50% of the economy controlled by the public sector, it's almost impossible to grow the economy. It's just too large and too overwhelming from a taxation and regulation perspective. And so we're just getting swamped in most of our Western countries. So again, this is why we need to have a real resizing of the state and people getting back to basics again.
So let's talk about the U.S. stock market now. The last time we spoke, the S&P was at 5,200. Now it's over 5,400. It's up 15% on the year. And in spite of all the potential landmines that we already discussed, are you concerned about the valuations in the S&P?
I mean, overall, we are, and as you know quite well, that even the last couple hundred points have probably been probably 50%. And that's Nvidia. I guess some Apple in there now recently. Anything that's got AI or any CEO that comes out and says they're expanding in AI, that stock's gone up. And so it's not broad based. And so it increasingly becomes narrow, which again gets us concerned. So when we look at the marketplace, yeah, we want to look at individual businesses and companies that are not going to be, we can make money in the next number of years that are reasonably valued. So we want to be careful. For example, let me something tangible. Apple comes out. We own Apple. We've had Apple in our portfolios for quite a few years, and it's not an insignificant position. It's probably about top, maybe it's the fifth largest in our overall portfolio. But when they came out and said, we're going to do AI, the stock jumps. Yeah, I don't know, $500 billion or something. Anyway, $400 or $500 in market cap. We're looking at that now, and we love Apple, and we think it's a great company and so forth. But it's expensive, so we actually are deciding to take a few percentage points off of our position. So if we have clients that have maybe 6 or 7% in Apple, we're looking at paring that down to 4.5%, and then we'll roll that into. In some cases, we might actually add to our Amazon position. We think it's much better, much more attractively priced, cash flow oriented, from cash flow perspective, growth perspective. It's been growing its business, AWS, all the different areas that they're involved in. And so we'll look at that and we say, okay, we'll make a sideways move. We'll get out of one that we think has just gotten a little bit ahead of itself, and we're a little bit more nervous about the valuation, and we'll go into something that we think clearly is better and more attractively valued. So it's all about those sort of movements, moving from one business to another. So yeah, the S&P's gone up and it's been pushed by just a limited number of companies. If we do have exposure to some of those, let's pare it back a little bit and let's reorient that and put it into other companies. And so we're really been twigging the portfolios more recently than we've ever done, and certainly in the last 4 or 5 years, as we're kind of fine tuning things, moving things around in the portfolio to take advantage of relative valuations and what we think will help protect our capital. But yeah, so the market, yeah, it could continue to go up. I just read some reports from some people that I have a great deal of respect for. They say, look, we'll see 6,000 in the S&P before it might get a blow off on the top and then back down again. So we'll see what happens. But we're looking at companies, James. We really look at the businesses and valuations, and not as much at the index level.
Well, 6,000 would be a significant move. And the second half of the year is going to be quite fascinating, to say the least. And Jonathan, I want to thank you very much for spending time with us today and sharing your thoughts on what you think about the economy and the markets. But if somebody would like to learn more about your firm, Rocklinc, where can they go?
Sure. Our on the internet is just rocklinc.com, and it's important. Rocklinc, that's with a C at the end for link, so ROCKLINC, rocklinc.com. And you can email us at info@rocklinc.com, and our phone number 905-631-5462. That's link 5462 at the end. And yeah, contact us. We'd love to talk to you. We've got a number of listeners of Wealthion, our clients now, and fantastic people. We love working with the different folks. And as you point out, if you just want to come in, there's no pressure, and we'll do an analysis. We'll tell you what we do. We'll give you an opinion on your portfolio for free, and give us a call. We'd love to do that, and look forward to speaking to some of the clients.
Once again, thank you. And we'll make sure we include a link to your website in the show notes below. Thank you.
Great. Thank you very much, James.
Well, I hope you enjoyed that discussion with Jonathan Wellum, and it gave you some insights on what to expect in the coming months. We all need help when it comes to planning and preparing for our financial future. And if you need help, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. There's no obligation to work with any of these advisors. It's a free service that Wealthion offers to anyone who has an interest. Don't forget to subscribe to our channel, wealthion.com, and also hit that notification button to be kept up to date on upcoming events. We have some amazing interviews coming out here in the coming days and weeks, all of which will help you be a better investor. I want to thank you once again for spending time with us today, and I look forward to seeing you again soon.